Let me ask you something. If your head of claims walked into your office right now and asked you to reconcile every settlement payment against your finance ledger, how long would that take you? A day? A week? Would you even know where to start? My name is Carlton, and I work at the intersection of two worlds that don't talk to each other nearly enough: specialist insurance and data engineering. I have a background in specialist insurance, London markets, Lloyd's broking, and specialty lines. And on this channel, I'm going to show you exactly how to use data engineering and data analytics to answer the questions that keep insurance professionals up at night. Such as, are my claims figures and my finance figures actually telling the same story? When a loss is settled across a co-insured program, who owes what and to whom? Can I demonstrate to Lloyd's right now that every single trust fund movement is clean, reconciled, and audit ready? In the upcoming episodes, we're going to take the complex financial realities of co-insurance, claims apportionment, trust fund reconciliation, and commission tracking, and turn them into clean, automated dashboards and reports that give you answers in seconds, not days. No fluff, no theory for the sake of it. Real problems, real solutions. And here's the part that might surprise you. Every dashboard, every report you're about to see was built using AI. Powered by data engineering that did the hard work first, structured the data, defined the fields, built the model. So that when AI was handed the question, it already had a clean, reliable answer to work with. That combination, data engineering plus AI, is what this channel is about. Let's get into it. Before we get into the detail, let me explain what you're actually looking at. Think of this as an intelligent settlement statement, one that updates itself automatically every time a transaction is posted in the system. In insurance, a settlement statement summarizes the financial position of a claim: what has been paid, what is still reserved, what fees have been incurred, and how the money has been distributed across the parties involved. This does exactly that, but at scale, across every settlement in the portfolio, all in one place. Every row represents a single settlement. Every column represents a specific financial dimension of that settlement. Let's take them one by one. So the first field is settlement ID, and this is simply the unique reference number for each claim settlement. Think of it like a receipt number at a till. Every time a claim is settled between an insurer and a client, the system generates a unique ID so that everyone, the broker, the insurer, the finance team, can refer to the exact same transaction without any confusion. Without this, you would have no way of knowing which payment belongs to which claim. It is the anchor that holds the entire row of data together. Paid claim, now we get into the money. Paid claim is the actual loss amount that has been paid out on a claim, the core indemnity payment. So if a client had a warehouse fire and the insurer agreed to pay £500,000, that £500,000 would appear here. What is important to understand is that the system is very specific about what qualifies as a paid claim. It only counts transactions where the payment type is either CM, which stands for cash movement, or RF, which stands for reserve funded. And it deliberately excludes anything that looks like a fee. So this column is a clean, pure measure of how much money has actually left the insurer's account to compensate the client for their loss. Paid fees. Paid fees sits right next to paid claim and uses almost identical logic, but instead of capturing the loss payment itself, it captures the fees associated with settling that claim. These would typically be things like loss adjuster fees, legal costs, or expert surveyor charges. The system uses the same payment type codes, CM and RF, but this time it only counts transactions that have been flagged as a fee rather than a loss. This distinction matters enormously in insurance because regulators and auditors require you to report the cost of compensating someone for their loss completely separately from the cost of handling and processing that claim. Outstanding. This one is really important. Outstanding represents the reserve, the amount of money the insurer believes it still owes on a claim that has not yet been fully settled. Think of it like this. Imagine someone makes a large property damage claim, but the investigation is still ongoing. The insurer cannot pay out yet, but they still need to set aside money to cover what they expect to pay. That set-aside amount is the outstanding reserve. In the data, it is identified by the posting type code OS, which literally stands for outstanding. Having accurate outstanding figures is critical because it directly affects how much capital an insurer needs to hold by law. Outstanding fees. Outstanding fees follows the same concept as outstanding, but specifically for the fee element. So if the loss adjuster is still working on a case and has not yet submitted their final invoice, the estimated amount for that invoice would sit here. Again, it uses the OS posting type code, but only picks up transactions flagged as fees. It is a relatively small number in most portfolios, but regulators under frameworks like Solvency II require it to be reported separately from the pure loss reserve. Apportionment, paid claim. Now this is where things get a little more interesting, and this is very specific to how the London insurance market works. In London markets, a single large risk, say insuring an offshore oil platform, is rarely covered by just one insurer. It might be split across 20 different insurers, each taking a percentage share of the risk. This is called a co-insurance placement. When a claim is paid, each insurer pays their share. Apportionment paid claim captures those shared or allocated claim payments, where the total loss has been divided up and apportioned across the market. The type code the system looks for here is PC, which stands for paid claim in the apportionment context. So while paid claim captures the direct payment, apportionment paid claim captures the market-wide allocated share of that same payment. Apportionment paid fees. Following exactly the same logic, apportionment paid fees captures the fee element of those shared market payments. So when the cost of loss adjusting or legal services is split across the co-insurance market, the allocated fee portions land here. The type code the system uses is PFS, paid fee share. It is a relatively niche field, but essential for a broker or MGA who needs to produce accurate claims bordereau. That is the detailed claims report submitted to each insurer in the market showing exactly what their share of every payment has been. Apportionment commission is the fee that a broker earns for placing the risk in the market in the first place. Apportionment commission specifically tracks the commission that flows through credit type accounts. And if that means nothing to you yet, just think of credit accounts as the accounts where money is received rather than paid out. The system looks for a type code of CS, which stands for commission settlement, and it only counts it where the account type is coded as C for credit. What this gives us is a very precise view of broker commission that has been formally settled and allocated through the apportionment process, as opposed to commission that might be sitting somewhere else in the ledger. Apportionment funds withheld. This one is quite specialist and comes up most commonly in reinsurance. In a standard insurance arrangement, the premium is paid upfront to the reinsurer. But in a funds withheld treaty, which is a specific type of reinsurance contract, the cedant, that is the company buying the reinsurance, actually holds on to the premium rather than transferring it. They keep it in their own accounts. Apportionment funds withheld captures those amounts, money that is technically owed to another party but is being legitimately retained under the terms of a treaty. The type code is FW, funds withheld. And like apportionment commission, it only applies to credit account types. For an actuary or finance director, this number feeds directly into their net settlement position calculations. Apportionment commissional. Finally, apportionment commissional is the broader version of apportionment commission. The difference is subtle but important. Apportionment commission only counted commission flowing through credit type accounts. Apportionment commission all counts commission settlements, type code CS, across every account type in the system, not just credit. So it gives you the complete picture of all commission that has been allocated and settled across the entire apportionment structure. Think of it, CE, as the total commission figure before any account type filtering is applied. For a broker's finance team, this is the number that feeds their revenue reconciliation, making sure that every penny of earned commission has been correctly captured and accounted for across every settlement in the portfolio. So that is the full set of fields. What I hope you can see is that this is not just a table of numbers. Each field has been very deliberately engineered to answer a specific financial question. Who was paid? How much? Was it a loss or a fee? Was it direct or shared across the market? Is there still money owed? And has the broker been correctly compensated? Together, these 10 columns give you a complete financial fingerprint of every single claim settlement in the portfolio. And that is the power of a well-designed data model. But knowing what the fields mean is only half the story. In the videos coming up, we are going to put these fields to work, using Claude AI for Excel to turn each one of these columns into real, actionable business insight. We will start with claims financial reconciliation, then move through apportionment and co-insurance transparency, trust account monitoring, commission and funds withheld tracking, fee versus loss segregation, and finally bring everything together in a full executive portfolio report. Each video will show you exactly how these fields answer the questions that keep insurance professionals up at night, one prompt at a time. So, you should by now be very familiar with this table. We spent time breaking down every single column, what it means, where they come from, and why it matters to a specialist insurance business. Now we are going to put it to work. But before we dive in, let me set the scene with a question that comes up time and time again when I'm sitting with claims and finance teams during a data project. How confident are you that your claims figures and your finance figures are telling the same story at any given moment? Think about that for a second. In the London market, your claims team is typically working out of a claims management system. Your finance team is working out of a ledger or an accounting platform. And somewhere in between those two worlds, there is almost always a gap, a figure that doesn't match, a settlement that appears in one system but not the other, a reserve that has been updated on the claim side but hasn't fed through to finance yet. And the problem is not that people are doing anything wrong. The problem is that both teams are looking at different cuts of the same data. And when your bordereau submission is due, or when a senior stakeholder asks for the numbers, somebody has to manually reconcile those two pictures. And that takes time that nobody has. What I am going to show you right now is how to change that. We are going to use Claude AI for Excel to build a settlement-level reconciliation view directly from the data in our table that brings paid claims and outstanding reserves together in one place, flags the positions that need attention, and gives every team the same number to work from. Let's go. The first thing I want to do is get a portfolio-level summary. I want to understand the total paid claims position and the total outstanding reserves across the entire book. So let me type in the first prompt now. Summarize the total paid claim and outstanding amounts across all settlement IDs. Highlight any settlements where outstanding is greater than paid claim and flag these as potentially under-reserved positions. And there we go. Now what Claude has done here is really interesting, and this is the bit I want you to pay attention to. It has not just given us totals, it has actually gone through every single settlement row and compared the outstanding reserve against what has already been paid. And anywhere it finds a settlement where the outstanding amount is larger than the paid claim, it has flagged that as a potentially under-reserved position. Now in a real London markets context, that flag is significant. An under-reserved settlement means the insurer may be holding less capital against that claim than the expected final cost warrants. And if that pattern appears across multiple settlements simultaneously, that is the kind of thing that needs to be in front of your reserving actuary before it becomes a regulatory conversation. With a traditional approach, finding those positions would mean writing a formula, filtering a pivot table, cross-referencing a separate report. We just did it in one prompt. Right, let me now take this a step further, because a summary flag is useful, but what I really want is a structured table I can actually present, something I can drop into a management pack or share with the finance team without any further formatting work. So let me type the second prompt. Create a table showing settlement ID, paid claim outstanding, and a calculated incurred loss column, paid claim plus outstanding, sort by incurred loss descending to identify the largest open exposures. Perfect. So what we now have is a clean, ranked table, settlement ID down the left, paid claim, outstanding, and then a calculated incurred loss column, which is simply the two added together, giving us the total financial exposure on each settlement, paid and unpaid combined. And critically, It is sorted from largest to smallest. So the very first row in this table is the settlement with the biggest total exposure on the entire book. Your claims director, your CFO, your lead underwriter, whoever picks this up, immediately knows where to look first. That is the power of settlement level data. You are not managing averages or aggregates. You are looking at individual positions, ranked by financial exposure, with no ambiguity about which ones matter most, and we built that in 2 prompts. Now, I want to just take a moment before we move on, because I think it is worth stepping back and appreciating what just happened. We started with a raw data table, 15 columns, 2,000 settlements, numbers that, on their own, tell you very little. In 2 prompts, we have a portfolio-level reserve adequacy summary, a ranked exposure table with a calculated incurred loss column, and a set of flagged positions that your reserving team needs to look at. No formula writing, no pivot table wrangling, no cross-referencing between systems. But before we move on, I want to highlight one important point, because what Claude just did looked effortless, and it was. But that effortlessness did not come from nowhere. Think about what those 2 prompts were actually working with. Paid claim is not a raw transaction field. It is the result of a T-school view that filters specifically for posting type codes CM and RF, excludes anything flagged as a fee, and excludes any transaction linked to an apportionment settlement ID. Every one of those conditions had to be designed, written, and tested long before anyone opened Excel. An outstanding uses the OS posting code, applying the same is-fee logic to separate loss reserves from fee reserves at source. That separation is what made our reserve adequacy comparison meaningful. Without it, the flag Claude produced would have been comparing the wrong numbers, and nobody would have known. That is the data engineering underneath this, the view that defines exactly what paid claim means and exactly what outstanding means, consistently across every single one of those 2,000 rows. Once that definition exists, once the data has been shaped correctly at source, Claude AI for Excel can reconcile, rank, and flag a portfolio in 2 prompts. The prompt is easy. The column meaning exactly what it says every time. That is the hard part. And that is data engineering. In the next section, we are going to move on to apportionment and co-insurance transparency, which is where things get really interesting, because this is where the London market's unique placement structure starts to show up in the data, and where the data engineering underneath it becomes even more important. In the last section, we built a settlement-level reconciliation view using Claude AI for Excel, bringing paid claims and outstanding reserves together, flagging under-reserved positions, and ranking every settlement by incurred loss. That answered the first question: are my claims figures and finance figures telling the same story? Now the second question, and this one is specific to how the London market works. When a loss is settled across a co-insured program, do you know exactly what your client owes versus what the syndicate stack is absorbing? To answer that, we need to talk about apportionment. In the London market, a single risk is rarely placed with one insurer. A property risk, a marine cargo program, a professional liability tower, each placed across multiple insurers, each taking a percentage line. That is co-insurance. And when a claim comes in, the settlement involves a series of allocated payments, each insurer paying their share. Alongside that, you have client-specific payments, third-party trust flows, and commission allocations, all happening simultaneously, all needing to be tracked separately. The field that captures all of this is apportionment paid claim. It answers, how much was driven by the market apportionment process? How much went directly to the client? How much moved through trust accounts? Without that answer, you cannot produce an accurate claims bordereau, tell each co-insurer their share, or demonstrate to your client that what they received matches what the program was obligated to pay. Let me show you how Claude AI for Excel handles this. In 2 prompts. Let me type the first prompt now. Compare apportionment paid claim against paid claim for each settlement ID. Where apportionment paid claim exceeds paid claim, flag these rows and provide a summary count and total value. What Claude has produced is a settlement-by-settlement comparison with flagged rows clearly identified and a summary count and total value at the bottom. When the apportioned amount consistently exceeds the direct payment, it signals one of three things: a timing difference, a data quality issue, or a structural anomaly in the placement. Each requires a different response, but you cannot investigate until you can see the pattern. That is exactly what this prompt has given us, in seconds, not hours. Now let's go one level deeper. Knowing the apportioned amount differs from the direct payment is useful, but what I really want to understand is the composition of the total paid claim. Specifically, how much was a direct client payment and how much moved through third-party trust accounts. This is where apportionment client paid claim and paid claim TP come in, and together they give us a payment split that is central to bordereau reporting and co-insurer reconciliation. Let me paste in the second prompt. Produce a breakdown showing the split between direct client payments, apportionment client paid claim, and third-party payments, paid claim TP, as a percentage of total paid claims per settlement. And there it is. For each settlement, Claude has calculated what proportion of the total paid claim was a direct client apportionment, and what proportion moved through third-party trust accounts, each expressed as a percentage of paid claim. That third-party percentage is directly relevant to Lloyd's trust fund compliance. Money moving through premium trust fund accounts needs to be identifiable and reconcilable at all times. And the client payment percentage is exactly what should feed a client's claims experience report at renewal, produced from clean data, not assembled by hand the night before. 2 numbers per settlement across 2,000 rows, 1 prompt. Let me pause here because it's worth being clear about what we've just shown. Apportionment is one of the most complex areas of London markets data, not because co-insurance is hard to understand. The concept is simple. It's complex because the underlying data sits across multiple tables, uses posting codes and account flags invisible to anyone outside the model, and produces payments flowing in several directions at once. We've just collapsed all of that into 2 clean outputs using 2 prompts in Claude AI for Excel. Next, we'll move to trust account, monitoring Lloyd's compliance and demonstrating that trust fund movements are clean and audit ready. But first, a quick word on what's sitting underneath everything we've done. You might be wondering, where does data engineering fit in? Claude took 2 prompts and gave us the answer. So what's the data engineer's role? Well, none of this works unless the data has already been modeled correctly. Apportionment paid claim doesn't exist in source data. It is the output of a structured data layer joining 7 tables, each one encoding specific business logic. What counts as a claim versus a fee? What distinguishes a credit account from a trust account? What defines a client-specific apportionment? That logic is designed, written, and tested long before anyone opens Excel. The data engineer builds and maintains that layer, shaping raw transactional data so every column means one consistent thing every time across 2,000 settlements. Once that foundation exists, Claude AI becomes transformative. An analyst or a finance director can ask questions in plain English and get accurate answers because the hard work of defining the data is already done. Claude did not magically understand apportionment paid claim. It understood it because data engineering gave that column a precise, consistent definition. The prompt is easy, the column meaning exactly what it says every time. That is the hard part. That is data engineering. That is the heart of this channel. Not replacing data engineers with AI. It is engineers building the right foundations, then using Claude AI to put accurate analytics directly into people's hands. So in the last section, we used Claude AI for Excel to compare apportioned claim payments against direct payments and to break down the split between client payments and third-party trust flows for every settlement in the book. That gave us a clear answer to the second question. When a loss is settled across a co-insured program, do you know exactly what your client owes versus what the syndicate stack is absorbing? Now I want to move to the third question. And if you have ever sat across the table from a Lloyd's auditor, you will know exactly why this one matters. But first, let me start with a question that comes up time and time again when I'm sitting with compliance and finance teams during a data project. If a Lloyd's auditor asked you tomorrow to show every payment that has moved through your premium trust fund accounts on settled claims, and to prove that each of those movements has a corresponding reconciled commission entry, how would you even begin? This is the territory of third-party paid claims and third-party paid fees, the fields in our data model that capture third-party payments flowing through trust accounts. In a Lloyd's syndicate, money held in trust is subject to strict segregation rules. It cannot simply move in and out without a clear, traceable, reconciled trail. And critically, where a trust movement relates to a commission arrangement, there should be a corresponding third-party apportionment commission entry. If that entry is missing, if money has moved through a trust account but no commission has been recorded against it, that is exactly the kind of gap a regulator is trained to find. And it is exactly the kind of gap that, left unaddressed, turns a routine audit into a much longer conversation. In the next part of this video, I am going to run 2 prompts in Claude AI for Excel and show you how quickly that gap can be identified, named, and handed to your compliance team before anyone else sees it. So, you should by now be familiar with this table. We have covered every field in detail and we have been building on it section by section. Claude AI is open here in the panel on the right. The first thing I want to do is get a complete picture of trust account activity across the portfolio. I want to know which settlements have third-party payments at all, what those payments total, and how significant they are relative to the overall paid claims position. So let me type the first prompt now. Summarize all settlements where paid claim TP or paid fees TP is greater than 0. Show total values and what proportion of overall paid claims these represent. Label this the trust account activity summary. So here is our trust account activity summary. Claude has filtered the entire dataset down to only those settlements where money has actually moved through a third-party trust account, either as a claim payment or a fee payment. It has totaled both of those columns and then expressed the trust-related claim total as a proportion of the overall paid claims figure across the whole portfolio. Now think about what this gives you. If you are preparing for a Lloyd's audit, this is your starting point. This is the population. Before you can demonstrate that trust movements are clean and reconciled, you first need to know exactly how many settlements involve trust activity and how much money is actually in scope. That sounds obvious, but in practice, identifying that population manually across a portfolio this size is a significant piece of work in itself. We just did it in one prompt, and the proportion figure at the end tells you immediately how material trust account activity is to your overall claims book, which is exactly the kind of context a finance director or compliance lead needs before walking into that audit conversation. Now let's go one level deeper. Knowing the size and scope of trust account activity is the first step, but what really matters to an auditor is whether each of those movements has been properly accounted for. Specifically, where a third-party claim shows money has moved through a trust account, there should be a corresponding third-party apportionment commission entry. If that entry is missing, it is a potential reconciliation gap. Let me type the second prompt. Identify any settlements where paid claim TP is populated, but apportionment commission TP is 0. List these as exceptions requiring review for potential trust fund reconciliation gaps. And there you have it. No exceptions found. Every single settlement where paid claim TP is populated has a corresponding apportionment commission TP entry, a clean one-to-one match across all 2,000 rows. Now I want you to think about what that actually means in practice. Walking into a Lloyd's audit and being able to say, we ran this check across every settlement in the portfolio, and there are 0 reconciliation gaps. That is not a small thing. That is the difference between an audit that concludes in a morning and one that runs for 3 days while your compliance team pulls transaction records by hand. The power here is not that we found exceptions. The power is that we can prove we looked thoroughly, systematically across the entire book and found none. That is a defensible position. And it took 1 prompt to establish it, 2 prompts, a complete view of trust account activity and a clean bill of health on commission reconciliation. Now, let me pause here for a moment because it's worth being clear about what we've just shown. Trust fund compliance is one of the most scrutinized areas in the Lloyd's market, and for good reason. Premium trust fund segregation rules exist to protect policyholders, and regulators take breaches seriously. But the complexity isn't in the rule itself. The rule is, trust movements must be clean and reconciled. The complexity is improving it across thousands of transactions, where the evidence is scattered across payment records, posting types and apportionment entries that don't naturally sit next to each other. We've just collapsed that complexity into 2 outputs, a complete activity summary and a named exception list using 2 prompts. Next, we'll move to commission in and funds withheld, tracking funds withheld, treaty structures, and how to keep net settlement positions visible. But first, a quick word on what's sitting underneath everything we've done. You might be wondering, where does data engineering fit in? Claude AI for Excel took 2 prompts and gave us the exception list. So what's the data engineer's role? Well, none of this works unless third-party paid claims and third-party apportionment commissions have already been modeled correctly. Neither field exists naturally in source data. They are the output of a carefully engineered data pipeline that identifies trust-type accounts, isolates third-party apportionment flows, and links each one back to its commission entry, all at settlement level. That pipeline is designed, written, and tested long before anyone opens Excel. The data engineer builds and maintains that view, shaping raw transactional data. Every trust movement and every commission entry can be reliably matched every time across 2,000 settlements. Once that foundation exists, Claude AI becomes transformative. A compliance lead can ask for an exception list in plain English and get an accurate named answer because the hard work of defining and linking the data is already done. Claude didn't magically know which settlements had reconciliation gaps. It knew because data engineering gave third-party paid claims and third-party apportionment commissions a precise linked definition. The prompt is easy. The fields meaning exactly what they say and being correctly paired every time. That's the hard part. That's data engineering. That's the heart of this channel. Not replacing data engineers with AI. It's engineers building the right foundations, then using Claude AI to put accurate audit-ready analytics directly into people's hands. So you will recall from the last episode, we used Claude AI for Excel to build a complete trust account activity summary, identifying every settlement where money had moved through third-party trust accounts, calculating what proportion of the overall claims book that represented and producing a named exception. List of settlements where trust movements had no corresponding commission entry. That gave us a clear answer to the third question. Can I demonstrate to Lloyd's that every trust fund movement is clean, reconciled, and audit-ready? Now I want to move to the fourth question, and this one sits at the intersection of claims and reinsurance, which is a space where the numbers can get complicated very quickly if you're not tracking the right things. The question is, if you operate under a funds withheld reinsurance treaty, are you tracking commission and retained premium movements alongside your claim payments in the same breath? But first, let me start with a question that sits right at the intersection of reinsurance structuring and data, and one that the data, if modeled correctly, can answer definitively. In a standard reinsurance arrangement, the cedant transfers premium to the reinsurer up front. Simple. But in a funds withheld treaty, that premium never actually leaves the cedant's books. The cedant retains it, holds it in their own accounts, and credits the reinsurer accordingly. That creates a specific data challenge. The net settlement position on any claim under that treaty is not just the claim amount. It is the claim amount adjusted for the withheld premium, the commission earned, and how those two figures relate to each other. When funds withheld represent more than 50% of commission earned, that is a signal for your actuary, your finance director, and your reinsurance operations team. It means something different to each of them, but it matters to all three. The fields that surface that picture are apportionment commission all, and apportionment funds withheld. And that is exactly what we are going to look at now. Settlement by settlement across the entire portfolio with just 2 prompts. Let's get to it. So, you should by now be very familiar with this table. We have been building on it section by section, and by this point you know exactly what these columns represent and where they come from. Claude AI is open here in the panel on the right. What I want to do first is get a settlement level view of commission and funds withheld side by side, and then calculate a ratio that tells us for each settlement how much of the commission earned is being absorbed by funds withheld. Anything above 50% is a flag worth examining. Let me go ahead and type in the first prompt. Produce a summary table showing apportionment commissional, and apportionment funds withheld per settlement ID. Calculate the ratio of funds withheld to commissional and flag any settlement where this ratio exceeds 50%. And there we have it. Let me walk you through this. Claude has produced a clean settlement level table, commission on credit accounts, total commission across all accounts, and funds withheld sitting side by side for every settlement. And then a calculated ratio column. Funds withheld divided by commissional, with every row where that ratio exceeds 50% clearly flagged. Now in a reinsurance context, that 50% threshold is not arbitrary. It is a practical signal. When the funds being withheld represent more than half of the total commission earned on a settlement, the net cash position of that treaty starts to look very different from what the gross figures suggest. The reinsurer has exposure on the claim, but the cedant is holding back a significant portion of the consideration that offsets it. For a finance director reviewing reinsurance treaty performance, that flagged list is a direct action item. For an actuary building a net settlement model, it is an essential input. And for a reinsurance operations team reviewing whether treaty terms are being applied correctly, it is the starting point for a conversation with the counterparty. We have just built that list across 2,000 settlements in one prompt. Now let's step back from the settlement level and look at the portfolio as a whole, because individual flags are useful, but what really drives strategic decisions is the aggregate picture. Specifically, across the entire book, what is the total funds withheld position relative to total commission earned? And what does that ratio actually mean for net settlement exposure? So let me type in the second prompt. Show the total apportionment funds withheld across all settlements and compare this to total apportionment commissional. Provide a written interpretation of what this ratio means for net settlement exposure. Great. And this is the output I really want you to pay attention to. Claude has not just given us the two totals and a ratio. It has provided a written interpretation, in plain English, of what that ratio means in the context of net settlement exposure. And that matters because this is the kind of number that gets asked about in a board meeting, in an actuarial review, or in a reinsurance treaty negotiation. The raw figures, total funds withheld, total commission, are inputs. The interpretation is the output that drives the decision. If the ratio is high, if funds withheld represent a large proportion of total commission across the book, it suggests the cedent is retaining significant premium relative to what it is earning in commission, which has implications for liquidity and for how net recoveries are modeled under stress scenarios. If the ratio is low, it suggests the funds withheld structure is operating as a relatively modest offset against commission income, lower risk, more straightforward to model. Either way, you now have a portfolio-level interpretation of that position, produced directly from the data without a single formula written by hand. Let me pause here, because it is worth being clear about what we have just demonstrated. Funds withheld treaty structures are one of the more technically demanding areas of reinsurance data, not because the concept is obscure, but because the data that describes them sits across commission entries, apportionment tables, and account type flags that require careful modeling to bring together correctly. We have just collapsed that into two outputs: a flagged settlement level commission table and a portfolio level interpretation of net settlement exposure, using two prompts in Claude AI for Excel. Next, we move to fee versus loss segregation and the regulatory reporting requirements that make that distinction non-negotiable. But first, a quick word on what's underneath everything we've done. You might be wondering, where does data engineering fit in here? Claude produced a written interpretation of net settlement exposure from two totals. So what did the data engineer actually do? Well, none of this works unless apportionment commission all, and apportionment funds withheld have already been precisely defined and separated in the data model. Commission LL is not the same field as commission. One covers credit type accounts only, the other spans all account types. Funds withheld uses a completely different type code. Conflating any of these produces a ratio that is not just wrong, it is misleadingly wrong. The data engineer ensures those three fields are correctly separated, consistently populated, and reliably joined at settlement level, every time, across the entire portfolio. Once that foundation exists, Claude AI can interpret what the numbers mean. The interpretation is only as good as the data behind it. And the data is only as good as the engineering underneath it. That is data engineering, and that is what makes everything else on this channel possible. So in the last section, we use Claude AI for Excel to build a settlement level commission and funds withheld table, calculating the ratio of withheld funds against total commission earned, flagging the settlements where that ratio exceeded 50%, and then producing a portfolio level interpretation of what that means for net settlement exposure. That gave us a clear answer to the fourth question. If you operate under a funds withheld reinsurance treaty, are you tracking commission and retained premium movements alongside your claim payments in the same breath? Now I want to move to the fifth question, and this one sits squarely in the territory of regulatory reporting, which is an area where precision is not optional. The question is, when your regulator or your auditor asks you to split loss payments from loss adjustment expenses, how quickly can you produce that? Let's find out. But first, let's start with a question that sits right at the intersection of regulatory compliance and data, and one that the data, if modeled correctly, can answer definitively. In insurance, there are two fundamentally different types of payment that come out of a claim. The first is the indemnity payment, the amount paid to compensate the policyholder for their actual loss. The second is the loss adjustment expense, the cost of investigating, managing, and settling that claim. In everyday conversation, people often refer to both of these loosely as the claim cost. But under IFRS 17, the international accounting standard that governs insurance contracts, and under Solvency II, these two components must be reported separately. And for Lloyd syndicate business forecast submissions, the split between indemnity and loss adjustment expense is a required disclosure, not an optional one. If you cannot produce that split cleanly from a single reliable source at any point in time, you have a reporting problem. And in my experience, the reason most businesses struggle with this is not that the data does not exist. It is that the data has not been structured in a way that makes the segregation automatic. In a well-engineered data model, that segregation is already built in at source. Paid claim and outstanding represent the indemnity side. Paid fees and outstanding fees represent the loss adjustment expense side. Every transaction has been flagged before it ever reaches a report or a dashboard. And that is the data engineering doing its job quietly in the background. And in the next 2 prompts, I'm going to show you exactly what that looks like in practice and why getting that engineering right is what makes everything Claude AI for Excel produces completely reliable. So, you should by now be very familiar with this table, and by this point in the series, you will recognize immediately which columns we are working with. Claude AI is open here in the panel on the right. The first thing I want to do is look at fee loading settlement level. Fee loading is simply the ratio of fees to the paid claim. It tells you, for every pound paid out in indemnity, how many pence was spent managing and settling that claim. And where that ratio is high, above 20% is the threshold we are going to use, it flags settlements where the cost of handling the claim is disproportionate to the loss itself. That kind of outlier has several possible explanations. A complex disputed claim with heavy legal involvement, a high-value loss adjuster engagement on a relatively modest loss, or simply a data quality issue, a fee that has been posted against the wrong settlement. Whichever it is you want to know about it, let me type the first prompt. For each settlement ID, calculate the fee loading ratio by dividing paid fees by paid claim. Highlight any settlements where fees represent more than 20% of the paid claim amount as outliers for review. So, here is the fee loading table. Every settlement with a calculated ratio sitting alongside paid claim and paid fees, and the outliers clearly flagged. Now let me just draw your attention to what this list actually represents in a business context. Each flagged settlement is a question that your claims management team needs to be able to answer. Why did it cost this much to settle a loss of this size? Is this consistent with the type of claim? Is the fee structure aligned with what was agreed with the loss adjuster or legal panel? These are not difficult questions to answer once you know which settlements to ask them about. Before this prompt, finding those settlements would have meant building a calculated column manually, applying a filter, and cross-referencing a separate fees schedule. We just did it across 2,000 rows in one prompt. And that flagged list is also directly useful for your claims handling expense analysis, a key input into pricing and reserving models for any specialty insurer that wants to understand the true all-in cost of a settled claim. Now let's move from the settlement level to the regulatory level, because the fee loading analysis gives us an operational view. It tells us where to look for anomalies. What I want now is a disclosure-ready summary, the kind of table that feeds directly into a regulatory return or an IFRS 17 reporting pack. Specifically, I want to see total paid claim, paid fees, outstanding, and outstanding fees as separate line items formatted as an indemnity versus loss adjustment expense split. Let me type the second prompt. Produce a regulatory summary table showing total paid claim, paid fees, outstanding, and outstanding fees as separate line items. Format this as an IFRS 17 disclosure-ready split between indemnity and loss adjustment expense. And there it is, a clean 4-line regulatory summary table. Indemnity side, total paid claim, and total outstanding, representing the actual loss payments and the reserves held against future payments. loss adjustment expense side, total paid fees and total outstanding fees, representing the cost of handling those claims and the reserves for fees not yet invoiced. This is the exact structure required under IFRS 17 for insurance contract liability disclosure. It is also the structure your Lloyd's SBF submission expects when you are reporting claims development by component, and it is the structure your external auditor will want to see reconciled back to your general ledger at year-end. What would normally require a finance team to manually aggregate figures from multiple system reports, apply account code mappings, and format the output to a specific disclosure template, we have just produced in one prompt, directly from the source data, with the indemnity and expense split already applied. 2 prompts, a flagged fee loading analysis for claims management and a disclosure-ready regulatory summary for finance and reporting. Let me pause here because it is worth being clear about what we have just demonstrated. Fee versus loss segregation sounds straightforward in principle. Separate the indemnity from the expense. But in practice, across a large portfolio with hundreds of transaction types, posting codes, and account classifications, maintaining that segregation cleanly and consistently at source is genuinely difficult. We have just produced a flagged fee loading analysis and a regulatory disclosure table from 2 prompts in Claude AI for Excel. Next, we move to the final section, downstream analytics and portfolio reporting, where we bring everything together into a single executive view. But first, a quick word on what is sitting underneath all of this. None of this works unless paid claim, paid fees, outstanding, and outstanding fees have already been correctly separated in the data model. That separation is not cosmetic, it is structural. Underneath everything Claude just produced, a data engineer has applied the is-fee flag at transaction level, consistently, across every single posting. That flag is what separates a fee from a loss at the point the transaction is recorded, not at the point of reporting, not at the point of prompting. At source. Without that flag being set and filtered correctly, the fee loading ratio measures the wrong thing and the regulatory table discloses the wrong figures. The output looks clean, the numbers are not. The data engineer ensures that never happens, maintaining the separation between fee transactions and loss transactions across every account type and every posting code in the system, long before anyone opens Excel. Once that engineering exists, Claude AI can turn it into a disclosure-ready regulatory summary in one prompt. The speed is Claude's. The accuracy belongs to the data engineering underneath it. That is the combination this channel is built on, and that is why data engineering is never the optional part. So in the last section, we used Claude AI for Excel to calculate fee loading ratios at settlement level, flagging the outliers where fees represented more than 20% of the paid claim, and then produced a disclosure-ready regulatory summary. Table splitting indemnity from loss adjustment expense formatted for IFRS 17 reporting that gave us a clear answer to the 5th question. When your regulator or your auditor asks you to split loss payments from loss adjustment expenses, how quickly can you produce that? Now, I want to bring everything together because everything we have built across the last 5 sections, the reconciliation, the apportionment analysis, the trust account monitoring, the commission tracking, the fee segregation, all of it feeds into one final question. And this is the question that sits above all the others, the one that lands on the desk of a CFO, a chief underwriting officer, or a client at renewal. The question is, what does my claims portfolio actually
look like? The portfolio
look
summary clearly demonstrates our strategy is working. Focus your attention here on the liability claims, which are down 20% year over year.
We'll achieve this with 3 prompts, but first, let me start with a question that sits right at the intersection of data and decision-making, and one that the data, if modeled correctly, can answer definitively. In specialist insurance, the claims portfolio summary is one of the most important documents a broker or insurer produces. It is what you hand a client at renewal to show them exactly how their program has performed. It is what you present to a board to demonstrate the financial health of the book. It is what an underwriter uses to decide whether to renew a risk, reprice it, or walk away from it. And yet, in most businesses I have worked with, producing that summary is a laborious manual process. Someone pulls figures from the claim system. Someone else pulls figures from the finance ledger. A third person reconciles the two formats, the output, and writes a narrative around it. By the time it lands in front of the client, it has taken 3 people the better part of a week to produce, and it is already out of date. What I'm going to show you now is a different way. We are going to use Claude AI for Excel to produce 3 distinct outputs from a single dataset, an executive dashboard table, a ranked top 10 exposure analysis, and a written client-facing portfolio summary, all in 3 prompts, the kind of output that would normally take a team days to assemble, built in minutes directly from the data. Let's get into it. So, you should by now be very familiar with this table. We have worked through every column in detail across the previous 5 sections, and by this point, you know exactly what each field represents and why it matters. The first thing I want to do is build the foundation. A complete portfolio-level executive summary, every column, every total, formatted and labeled so that it can be dropped directly into a board pack or a management information report without any further work. Let me type the first prompt. Create a portfolio summary showing total values for every column in this data set. Present this as an executive dashboard table with clear column labels and GBP formatted values. And there is the executive dashboard table. Every column from the dataset, paid claim, paid fees, outstanding, outstanding fees, all the apportionment fields, all the third-party trust fields, totaled at portfolio level, clearly labelled, and formatted in GBP. Now think about what this represents. This is the complete financial picture of 2,000 settlements collapsed into a single table. Total paid losses across the book, total fees incurred, total reserves still open, total funds moving through trust accounts, total commission earned and settled, total funds withheld under reinsurance treaties. Every single one of those numbers in one place, produced from source data in one prompt. This is what feeds a board MI pack. This is what a CFO looks at before a quarterly review. This is what a lead underwriter uses when they are deciding whether the book has performed within appetite. And producing it used to mean pulling figures from multiple systems and spending half a day formatting a spreadsheet. We just did it in 30 seconds. Now let's go one step further, because a portfolio total is essential, but it does not tell you where the risk is concentrated. It does not show you which individual settlements are driving the numbers. And in specialty insurance, concentration risk is everything. A book of 2,000 settlements might look perfectly healthy in aggregate, until you discover that 3 of those settlements account for 40% of the total incurred loss. That is the kind of insight that changes how you price the renewal, how you set the reserve, and how you structure the reinsurance. So let me type the second prompt. Identify the top 10 settlement IDs by total incurred loss paid claim plus outstanding. For each, show all financial components side by side and highlight which settlements have the highest apportionment activity relative to direct payments. Great. I want you to study this output carefully because Claude has ranked every settlement by total incurred loss, paid claim plus outstanding reserve, and surfaced the top 10. Every financial component sits side by side for each of those 10 settlements. And then it has done something particularly useful. It has highlighted which of those 10 have the highest apportionment activity relative to their direct payment. That last piece of analysis matters enormously in a London market context. A large settlement with high apportionment activity means the market has been heavily involved in absorbing the loss. The syndicate stack has been tested. The co-insurance structure has been activated at scale. And if those same risks are coming up for renewal, your underwriters need to know that. And they need to know it before they decide what line to write. We now have that analysis ranked across the entire portfolio for the 10 settlements that matter most in one prompt. Now for the final prompt, and this one is different from everything we have done so far, because what we are producing now is not a table or an analysis, it is a narrative, a piece of written communication. Because data, however clean and well-structured, does not speak for itself in a client meeting. At renewal, your client does not want to read a spreadsheet. They want to understand, in plain English, how their claims experience has looked over the period, what was paid, what is still open, what it cost to manage, and how the market performed. That narrative used to be written by a senior broker after spending an hour with the data. Let me show you what Claude AI for Excel can do with it. Let me type the third prompt. Produce a written client-facing claims portfolio summary based on this data. Include total paid losses, outstanding reserves, fee exposure, and apportionment activity. Write it in a professional tone suitable for a renewal meeting with an insured. And there it is. Amazing. A professional, client-facing portfolio summary, written in plain English, structured for a renewal conversation, covering every dimension of the claims experience. Total paid losses, outstanding reserves and what they represent, fee exposure and how it relates to the overall loss cost. Apportionment activity and what it tells us about how the market has responded to the program. Read that back to yourself and ask, could I hand this to a client at a renewal meeting? Could I include this in a broker's report without editing it? I think the answer, with perhaps a light review and your firm's specific context added, is yes. And that is the point. Claude AI for Excel has not replaced the broker's judgment or the analyst's expertise. It has removed the hours of drafting, formatting, and assembling that sit between the data and the conversation. The expert still owns the relationship. The expert still adds the context. But the foundation, the numbers, the structure, the professional narrative is already there. 3 prompts, an executive dashboard, a ranked exposure analysis, a client-ready portfolio summary. Let's take some time out here and reflect on what we have accomplished here, because across these 6 episodes, we have answered 6 questions that I know keep insurance professionals up at night. Are my claims figures and finance figures telling the same story? Yes, because the data has been reconciled at settlement level. Do I know what each co-insurer owes on a settled co-insured risk? Yes, because apportionment has been modeled correctly. Can I demonstrate trust fund compliance to Lloyd's right now? Yes, because trust account movements are tracked and exception tested at source. Am I monitoring commission and funds withheld alongside claim payments? Yes, because all 3 fields are correctly separated and linked in the data model. Can I split indemnity from loss adjustment expense for regulatory reporting? Yes, because the ISV flag is applied at transaction level consistently every time. And can I produce a complete portfolio view, executive, analytical, and client-facing on demand? Yes, in just 3 prompts. None of that is possible without the data engineering underneath it, the T-skill view that joins 7 tables, the posting type codes that distinguish paid from outstanding, the account type flags that separate trust from credit, the apportionment logic that allocates every settlement share to the right counterparty, the ISV flag that keeps indemnity and expense permanently separate. That is the foundation. And once that foundation is built correctly, Claude AI for Excel becomes something genuinely transformative. Not a replacement for expertise, but a multiplier of it. Putting the right answers into the right hands at the right moment without the weeks or months of manual effort in between. That is data engineering, that is data analytics, and that is what this channel is about. Thank you for watching. If this has been useful, please subscribe. And if anything in this series has sparked a conversation you feel you need to have about your own data, I would genuinely welcome the chance to be part of it. Building data solutions for specialist insurance businesses is what I do, and the problems we have walked through across these 6 videos are the ones I find most rewarding to solve. If you would like to explore what that could look like for your organization, the link to reach me is below. Thank you again for watching.